South Africa's largest general insurer, Santam, increased its final dividend as a result of strong earnings growth, even though it cut underperforming businesses that trimmed more than 1 billion rand off its premiums. Headline earnings per share rose 27% and it declared a dividend that was 7% higher than the previous year. For more, we are joined by Santam CFO Wikus Olivier. Wikus, thank you so much for your time. Take us through what drove the performance given the operating context.
Yeah, if I look at the bottom line level, we did increase our net income after tax and minorities by 64%. It's a combination of a very strong profit growth from our specialist solution business as well as our alternative risk transfer business. And then we also had the wind from the back a bit from investment market perspective, in that all of our portfolios delivered a very strong investment performance, supported by the markets, but also with our asset managers outperforming benchmarks for the year, which more than offset the negative impact that we had in some of our other business units that really felt the pain of adverse claims experience.
Speaking of claims, last year in conversation with your CEO, Tava, he did mention that the power surge claims for the first half were negligible. Were you seeing the same trend coming into the second half?
Yes, we definitely saw the same trend. You will recall that we struggled both with power surge claims, but also profitability with our motor book in 2022. Those we've now successfully addressed, with the motor book delivering strong profits, and really power surge claims has been fully mitigated. Our focus now turns to our property book, where we did see severe weather-related claims, including the hail in Gauteng in November last year, and also the 2 Western Cape floods. And in addition, we also saw quite a pickup in large fire losses in our commercial business.
When it comes to the My Way business, during the first half, you had announced initiatives that you would be focusing on to turn that business around. Are you seeing them, grow and improve margins, and what needs to be done?
Yes, I must say we've seen quite a positive turnaround in My Way's top-line growth. In the second half of the year, they ended the year in December growing their premiums by 7%, compared to about 3.5% growth at the mid-year point. So we are definitely seeing the benefits of actions that they implemented to reduce rejected debit orders, but then we're also seeing the benefits of the new strategic initiatives, in particular their tied agency in the commercial space, and also the inbound strategy starting to come through and supporting their growth. Their personal lines book still experience overall low growth, but within their business insurance and their value-added services products, they did see more than 20% growth. So we do expect this positive trend towards the end of the year to continue into 2024 as well.
If you had to look back over the years, what would you say when it comes to the market share trends that you're seeing in terms of the major business segments? What's your overall assessment?
Yes, if we look at Santam, we remain the biggest player within the market with a market share in excess of 24%. Which has actually been at that level for quite a few years. Within the specialist lines, we're by far the market leader, within some instances market shares of up to 50%. In our broker solution business, which still makes up 70% of our business, we deal with more than 3,000 brokers in the country. So there we're also one of the biggest players. But there are still segments where we don't have a fair market share yet, and one of those is in the direct market space, where part of our strategic initiatives is focused on scaling our direct businesses, which includes My Way, but also Santam Direct. And then the other business that we're very excited about is our partner solutions business, where the objective is to partner with businesses that's already got a large client base and to cross-sell our solutions into that base as well. And specifically within the partner solutions business, those type of partnerships will also enable us to reach the lower end of the market, which we can't reach through traditional channels.
In the short term, what's more important for you, market share gains or profitable growth?
Definitely profitable growth. So we remain focused on achieving our 24% return on capital hurdle rate, and that we can only achieve if we get our underwriting margin within that 5 to 10% range. That's our long-term target. So we definitely focused on profitability in the first instance, and that's why we were prepared to cut more than 1 billion of our premiums during the year. So we're prepared to rather take top-line strain in the short term if it will mean that we improve the overall profitability of the business over the long term.
With that said, how competitive is it out there for you?
South Africa remains a competitive market, and we see that across all of the market segments where we play. We literally right from insuring small devices up to big corporates across personal and commercial lines, and competition is stiff out there. So definitely we don't expect that to ease anytime soon. And in particular within the direct space is where we see the competitors really fighting for market share as well.
Given the environment that we're in, what's the priority for you and the rest of the team for the next 6 months or so?
I think from a profitability perspective, the focus will definitely be on fixing the property book and addressing the adverse claims experience that we've seen there. So that will definitely be high on the agenda. But then at the same time, is to drive the top line growth as well. We've got multiple initiatives around scaling our direct businesses, making further inroads into the broker segment as well. And as I mentioned, this is putting more partnerships in place that will enable us to accelerate growth over the long term, but also at the same time enhancing profitability.
Before I let you go, just quickly, and I promise there's no pun intended with this question, but what's the main risk for you and the team?
I think if you look at the risk landscape, the risk has definitely increased. We've seen increase in the frequency and severity of weather-related claims. I mentioned that fire claims is a particular issue, and that's not going to ease soon. So those are specific areas that can cause significant losses to us, and that's why we need to remain focused on managing our risks in that space.
Wikus, thank you so much for your time. That is Wikus Olivier, who is the CFO at Santam, taking us through the company's earnings. However, the share price, we did see it marginally up 0.7%.